Let me ask you something direct. If your lender approved you for a $500,000 mortgage tomorrow, would you sign it? Most people would say yes. And honestly, that's the problem. Because getting approved and actually being able to afford something are two completely different things. And in 2026, that gap between those two things has never been wider. So today we're going to sit down and actually do this math together. Not the math your lender shows you, the real math, the full picture. And by the end of this, you'll know exactly where you stand. And more importantly, you'll understand why so many people who thought they could afford a $500,000 house found themselves financially stressed within the first 2 years of buying one. Let's start with the basics. A $500,000 house in 2026 is not a mansion. It's not a luxury purchase. In Nashville, it's a decent 3-bedroom in a good neighborhood. In Austin, it barely gets you into certain zip codes. In Denver, it's completely normal. In parts of California and the Northeast, it's actually on the lower end of what's available. And in European cities like Amsterdam, Munich, or Dublin, a €500,000 property is simply a normal apartment in a livable neighborhood. So we're not talking about rich people problems here. We're talking about what hundreds of thousands of regular, working, responsible adults are trying to navigate right now. And the math is genuinely difficult. Let me show you exactly why. Let's say you earn $85,000 a year. That's a solid income, above the U.S. median. The kind of number that should, in theory, support a comfortable life and a reasonable home purchase. After federal taxes, Social Security, and Medicare, and let's say you're in a state with moderate income tax, you take home roughly $5,400 a month. That's your real number. That's what actually hits your bank account. Now you want to buy a $500,000 house. You've been saving. You have $45,000 put away. That took you probably 3 years of discipline and sacrifice. You're proud of it. You should be. But here's where we need to slow down and actually look at what happens next. A conventional mortgage requires 20% down to avoid private mortgage insurance. On a $500,000 house, 20% is $100,000. You have $45,000. So you're at 9% down. That means you're either waiting longer or you're buying with less than 20% and paying PMI on top of everything else. Let's say you decide to move forward. You put $40,000 down. Your loan amount is $460,000. You keep $5,000 as a buffer. Now, let's look at your actual monthly payment. In 2026, a 30-year fixed mortgage rate is sitting around 6.75%. At that rate, on a $460,000 loan, your principal and interest payment alone is $2,983 a month. But that's not your full payment. Not even close. Add PMI, because you put less than 20% down. That's roughly $200 a month. That money protects the lender, by the way, not you. Add property taxes, depending on your state and county. On a $500,000 home, you're looking at somewhere between $250 and $500 a month. Let's use $300 as a moderate estimate. Add homeowner's insurance, roughly $150 to $180 a month for a home this value. So your total monthly housing payment is now $2,983 plus $200 plus $300 plus $165. That's $3,648 a month. You take home $5,400. Your housing just consumes 67% of your take-home pay. And you still have to eat, still have a car, still have student loans, still have a phone bill, utilities, groceries, health insurance if it's not fully covered by your employer. All of that needs to come from the remaining $1,752. Let me be very straightforward with you here. That does not work. Not comfortably, not sustainably, and not without something breaking somewhere within the first 12 to 18 months. Now, maybe you're thinking, okay, but what if I earn more? What if I have a partner and we're buying together? Fair point. Let's run that version too. You and your partner earn a combined $140,000 a year. That's a strong dual income. Your combined take-home after taxes is approximately $8,900 a month. Much better. You have $60,000 saved together between you. Again, That took real effort and real time. On the same $500,000 house, same loan terms, your monthly housing payment is still $3,648. But now that's 41% of your take-home. That's more manageable. But now, let's add the rest of your life back in. Car payments. Let's say one car payment between you at $380 a month. Student loans. Very common for dual-income couples in their 30s. Let's say $600 a month combined, which is actually modest if either of you went to graduate school. Groceries for two people eating reasonably well, $500 a month. Utilities, internet, phone bills combined, $280 a month. Health insurance if your employer doesn't fully cover dependents, $200 a month. Dining, personal spending, subscriptions, the ordinary texture of a normal life, $600 a month. Add all of that up. Housing, $3,648. Car, $380. Student loans, $600. Groceries, $500. Utilities and phone, $280. Health, $200. General living, $600. That's $6,208 a month going out. You bring home $8,900. That leaves $2,692. From that $2,692, you need to rebuild your emergency fund. Remember, you use most of your savings for the down payment and closing costs. Closing costs on a $500,000 home, by the way, run roughly $10,000 to $15,000. So if you had $60,000 saved and you put $40,000 down and paid $12,000 in closing costs, you have $8,000 left in cash reserves the day you move in. On a $500,000 home, $8,000. Financial planners generally recommend 3 to 6 months of expenses as an emergency fund. Your monthly expenses are now over $6,000. So your target emergency fund should be somewhere between $18,000 and $36,000. You have $8,000. And your home, your brand new $500,000 home, requires maintenance. The standard planning assumption is 1% of the home's value per year. That's $5,000 a year, $417 a month. Some years you spend nothing. Then the HVAC breaks and you spend $8,000 in 1 month. The average works out to roughly that $417 figure. So you should be setting that aside every month. Now your $2,692 surplus has to cover emergency fund rebuilding for $117 a month in maintenance reserves, retirement savings beyond whatever your employer matches, and anything unexpected that life sends your way. You see the problem. And this is on $140,000 combined gross income. This is not a low-income scenario. This is solidly upper-middle-class America, trying to buy a normal house in 2026. And if you're in Europe right now, thinking this is an American problem, let me show you that it isn't. Take Amsterdam, a modest 2-bedroom apartment in a decent neighborhood, not central, not luxury, costs somewhere around 450,000 to 550,000 euros right now. Let's call it 500,000 euros. If you earn 65,000 euros gross per year in the Netherlands, which puts you well above the Dutch median income, your take-home after Dutch income tax and social contributions is approximately 3,700 euros a month. At current Dutch mortgage rates of around 4% to 4.5% on a 30-year mortgage, a loan of 450,000 euros generates a monthly payment of roughly 2,270 euros. Add service costs for the building, ground lease payments, which are common in Amsterdam, and insurance. You're at approximately 2,700 euros a month in total housing costs. You take home 3,700 euros. Housing takes 2,700. You have 1,000 euros for everything else. Food, transport, savings, clothing, any kind of social life. That is not a comfortable life. That is survival mode, living while technically being a homeowner. And 65,000 euros gross in Amsterdam is not a small salary. That's a professional salary. That's someone who went to university, built a career, did the things you're supposed to do. Same story in Munich. Same story in Dublin. Same story in Zurich. Though incomes are higher there too. The ratio is the problem, not the absolute number. Housing costs have grown faster than incomes in almost every major Western city over the past decade. And that gap is what makes the math so difficult right now. So here's what I actually want you to understand about why this keeps happening. Why people keep buying homes they can technically qualify for, but can't structurally absorb. It starts with your lender's pre-approval letter. When your bank or mortgage broker hands you a pre-approval for $650,000, because that's what your income qualifies for based on their debt-to-income ratios. Something happens in your head. That number becomes a kind of permission. It becomes a ceiling you measure yourself against. And suddenly a $500,000 house feels conservative, feels responsible, feels like you're being smart by staying well under your limit. But your lender is calculating based on your gross income, not your take-home, not your actual life expenses. They're checking whether you can service the debt, not whether you can build a financial life around it. Those are very different questions. And your lender is not in the business of asking the second one. That's your job. And then you start looking at houses. And this is where something shifts that's hard to explain, but very important to understand. When you walk through a physical space, when you stand in a kitchen, when you imagine your furniture in the living room, when you think about waking up in that bedroom, the house stops being a financial decision and starts being something you want. And once you want something, your brain starts working for the purchase, not on the purchase. It starts solving problems instead of identifying them. It starts building cases instead of testing them. The down payment you don't quite have become something to negotiate around. The closing costs you hadn't fully factored and become a seller concession to request. The monthly payment that's uncomfortably high becomes something you tell yourself you'll adjust to. And the realtor who's been showing you houses for 2 months and the lender who gets paid when you close. Neither of them is incentivized to tell you to slow down. This is not a personal failure. This is a very human response to a very specific set of circumstances. But understanding it clearly is what protects you from it. Now, let me show you what the long-term picture actually looks like if you go ahead with a purchase that's at the edge of what you can handle. On a $460,000 loan at 6.75% over 30 years, you'll pay approximately $614,000 in interest. Just interest, not principal. The house costs $500,000. The interest on financing the house costs another $614,000. Your total outlay over 30 years is over $1.1 million for a $500,000 asset. Now, real estate does appreciate in most markets over long periods. That's real. Inflation does erode the real value of a fixed mortgage payment over time. That's also real. Equity building is a form of forced saving. All of this is true and worth acknowledging. But those benefits accrue most cleanly to people who enter the purchase with structural stability, people who had a real down payment, people who had cash reserves after closing, people whose monthly payment didn't consume 60% or 70% of their take-home income. For those people, the long-term case for homeownership is solid. For people who entered undercapitalized, minimal down payment, minimal cash reserves, payment at the edge of what they can manage, what typically happens is this. An unexpected expense hits in year 1 or year 2. It goes on a credit card. That credit card starts carrying a balance at 22% interest. Meanwhile, retirement contributions stay at minimum because there's no margin to increase them. The emergency fund never gets rebuilt to a healthy level because every surplus dollar is going somewhere urgent. And 5 years into owning a $500,000 home, the financial picture isn't better than it was before the purchase. In some ways, it's more constrained. The house has equity, yes, but equity you can't access without a loan or a sale. Meanwhile, the monthly financial stress is real and immediate. So what does actually affording a $500,000 house look like? I want to be clear about this, because the answer isn't that you can never buy a home at this price point. The answer is about the conditions under which the purchase makes structural sense. You need to be able to put 20% down, that's $100,000, and still have 3 to 6 months of your new expenses in liquid savings after closing costs. On a budget where your new monthly expenses are around $6,000 to $7,000, That means $18,000 to $42,000 remaining in cash after the down payment and closing costs are paid. So realistically, before you buy a $500,000 house with genuine financial stability, you need somewhere in a range of $130,000 to $145,000 in savings, $100,000 for the down payment, $12,000 to $15,000 for closing costs, and $18,000 to $30,000 remaining as a real emergency fund. And your all-in monthly housing payment, mortgage, taxes, insurance, PMI if applicable, and a maintenance reserve should not exceed 28% to 30% of your gross monthly income. On a single income of $85,000, that ceiling is about $2,000 to $2,125 a month. A $500,000 house at current rates doesn't fit inside that number. On a combined income of $170,000, the ceiling is about $3,975 to $4,250. The all-in payment of roughly $3,650 fits tightly, but it fits if your other debts are minimal and your cash reserves are strong. This is why the people who buy homes at this price and remain financially stable are typically not people with higher incomes. They're people who delayed the purchase long enough to enter with real financial structure around it. They waited an extra year or two. They drove the same car longer. They stayed in the apartment that felt too small for one more lease cycle, not because they were more disciplined as individuals, but because they understood what they were actually waiting for. They were waiting for the math to actually work, not technically work, actually work. Look, I understand that waiting feels like losing right now. It feels like watching prices go up while you stand still. It feels like everyone around you is buying and you're falling behind. That feeling is real, and it's one of the most expensive feelings in personal finance because it pushes people into purchases before the structural conditions are right. But a house you buy 2 years too early, undercapitalized and overextended, doesn't put you ahead. It puts you in a different kind of financial trap. One that's harder to see because you're technically a homeowner, and homeownership is supposed to mean you've arrived somewhere. The $500,000 house in 2026 is possible for more people than it's comfortable for. That's the honest version of this. And knowing which category you're in, not which category your lender says you're in, but which category the actual math puts you in, is the most important thing you can know before you start seriously looking. Take your time with this math. Run your own numbers. Be honest about what you see. And if this kind of clear, direct financial analysis is useful to you, subscribing means you'll catch the next one. That's it. Nothing else to sell you. Just the math laid out straight.